Joining us this morning, talk more about the state of the economy, the markets, and maybe what we'll hear from Jay Powell a little bit later today. Meghan Graper, global co-head of debt capital markets at Barclays. Good morning to you. What are you expecting at 8:30? But maybe more importantly, what are you expecting at 2:30?
Yeah, I mean, I think a third consecutive hold is a given this afternoon. I think the bigger question is what's the path forward? That's going to be the more closely watched piece of the equation. And between a stronger than expected employment report and firming CPI, I think Powell arguably has even more rein than he had on December 1st to retain a tightening bias and to push back against this speculation of more rapid cuts. So, with that as the backdrop, I think we're calling for a dot plot that's likely to underwhelm market expectations. I think we likely see 2 25 basis point cuts in 2024 in that dot plot. And I'd expect to see also a nod to the easing of financial conditions since that November meeting. I think the bigger question is, will the market actually listen to Powell this time around?
Well, but let's talk about what that language even sounds like to get you to you're only talking about two cuts.
We're talking about it. Well, I think there are 2 cuts baked in the dot plot. I think, we are admittedly amongst the most hawkish on the street. Our call is actually for a single cut in December. And that's, and that if rate cuts do come in quicker succession, it's for all of the wrong reasons, meaning like there are more material cracks that have begun to show in the economy. And that's tied to the inflation landscape. I think barring more material progress on the inflation front, we think the risks remain skewed to the Fed easing at a fairly glacial pace. I think they're going to try to buy that optionality as part of the rhetoric here this afternoon. Well,
but that was going to say, in terms of the rhetoric, I made this point yesterday. Other people seem to disagree with me that if you're Powell, today's not the day to say, well, we're really thinking about easing in 24 and we'll talk to you about that. Why wouldn't you just sort of say we're going to be very data dependent and hang out? We're hanging out here for a while, not freak people out, but also you need some of the work to be done for you through the jawboning unto itself.
I think that's right. The market's clearly gotten over its skis here. So I think he needs to lean into a more hawkish stance. I think the suggestion will be that they'll keep a tightening bias and even potentially suggest in the language that if they need to hike again, they will. I think it's more about retaining control and ensuring they've got confidence that 2% target is within reach. At this point, based on yesterday's numbers, we've got a ways to go before that's the reality. And the easing of financial conditions is problematic for them.
So speak to that, though, just on a natural basis, how long do you think it would take to get to 2%? Just living through where we are now, supply chains, everything else.
Yeah, I think there's not a major economy barring China that probably gets to 2% inflation by year end 2024. Our call is 2.8% by year end. So I think we're well into 2025 before we're hitting that 2% landing. It doesn't mean they can't pivot and start cutting prior to that. I think they'll be preemptive, but we think that doesn't play out into the fourth quarter.
Okay, so for everybody else who's so-called playing at home right now, how do you see the equity markets reacting as a result of what you're just talking about?
I think we're reasonably optimistic as we head into the turn of the year. I think this is more about positioning. I think we're actually seeing the cuts priced into the market are reflective of a bullish sentiment. And, when we talk to buy-side players, they're looking to re-risk. So in my eyes, this is about, positioning, contributing to those 4 to 5 cuts that are baked in rather than some deeply rooted belief that the economy actually warrants those cuts. So we think we'll continue to see risk assets across asset classes hold in well, even with a slightly more hawkish stance from the Fed.